Understanding money laundering. Money laundering is the process of taking money earned through illegal activities, like drug trafficking, fraud, corruption, or smuggling, and making it look like it came from legitimate sources. Criminals do this because the money they earn illegally is often in cash and easily traceable. If they try to spend or deposit it without hiding its origin, law enforcement can seize it. So, money laundering isn't just about hiding the cash. It's about transforming dirty money into clean money so it can safely enter the financial system and be used for investments, purchases, or moving across borders. Why criminals need to launder money. Imagine a drug trafficker earning millions of dollars in cash. If they walk into a bank and try to deposit huge amounts without explanation, it will immediately raise suspicion. Most countries have anti-money laundering (AML) laws requiring banks to report suspicious deposits, especially those above certain thresholds, like $10,000 in the US. By laundering the money, criminals hide the link between their crimes and their wealth, allowing them to buy property, start businesses, fund more crime, or live luxurious lives without attracting unwanted attention. The classic 3 stages of money laundering. Money laundering typically happens in 3 main stages. These stages may overlap, but understanding them shows how criminals move dirty money through the system. Stage 1. Placement. This is the first and riskiest step, getting the illegal cash into the legitimate financial system. Because cash is hard to hide in large amounts, criminals need to deposit it in small increments or use businesses that handle a lot of cash, like restaurants, car washes, casinos, or bars. Common placement techniques include structuring or smurfing, breaking up large amounts of cash into smaller deposits spread across multiple bank accounts to avoid detection. Cash-based businesses, using legitimate cash-heavy businesses to mix illegal cash with real earnings. Currency exchanges, converting cash into other currencies to make it harder to trace. If authorities detect suspicious deposits at this stage, they can often link the money back to the original crime. Stage 2. Layering. Layering is the process of moving money through complex transactions to make it difficult to trace its original source. This stage often involves transferring money between multiple bank accounts, often across different countries with weaker regulations, buying and selling financial products like stocks, bonds, or cryptocurrency, creating fake invoices or shell companies to generate a paper trail that looks legitimate, using offshore accounts in tax havens where transparency is low. The purpose of layering is to create so many steps and transactions that investigators struggle to follow the trail. Stage 3. Integration. In this final stage, the money is returned to the economy in a way that looks clean and legitimate. Criminals can now use it to buy real estate, cars, art, or luxury goods, start or invest in legitimate businesses, make loans, or even fund other criminal operations. By this point, the money appears to be legally earned, making it extremely difficult for authorities to prove that it originally came from illegal activities. Real-world methods of money laundering. Here are some of the most common and notable methods. 1. Cash-intensive businesses. Criminals often buy or set up businesses that normally handle a lot of cash, such as restaurants, bars, and clubs, taxi services, parking lots, laundromats. These businesses give them a legitimate excuse to deposit large amounts of cash, mixing illegal earnings with real income so the money looks legitimate. 2. Trade-based money laundering. This involves manipulating the price, quantity, or quality of goods in international trade to move value across borders. For example, over-invoicing a shipment so more money is paid than the goods are worth. Under-invoicing so fewer taxes are paid. Because global trade involves so many transactions, this method is hard for authorities to monitor. 3. Shell companies and offshore accounts. A shell company is a business that exists only on paper. It doesn't make or sell anything but can hold bank accounts and move money. Criminals use shell companies, often registered in countries with weak regulations, known as tax havens, to hide their identity and move money across borders with less scrutiny. 4. Real estate investments. Buying property is a common way to launder money. Criminals can buy homes or commercial buildings with illicit cash, sometimes at inflated prices or through third parties. Later, they can sell the property and claim the profit as legitimate income. 5. Casinos and gambling. In jurisdictions with weak regulations, criminals can use casinos to launder cash by buying chips with cash, gambling a little, cashing out the remaining chips and receiving a check or bank transfer from the casino. This makes the money appear to come from gambling winnings rather than illegal activities. 6. Professional money launderers. Some individuals or groups specialize in laundering money for others. They often use sophisticated networks of accounts, businesses, and international contacts to move funds efficiently. These networks can be difficult for law enforcement to infiltrate because they operate like secretive financial service providers. 7. Cryptocurrency and digital assets. In recent years, criminals have turned to cryptocurrency for laundering because it can be moved across borders quickly and, in some cases, with a degree of anonymity. Techniques include converting cash into crypto, using mixing services, or tumblers, to obscure the source of funds, converting crypto back into cash or spending it directly. Regulators are catching up, but the rapid growth of decentralized finance, DeFi, continues to pose challenges. The global effort to combat money laundering. Governments around the world take money laundering seriously because it fuels organized crime, terrorism, and corruption. Know your customer, KYC, rules. Banks must verify the identity of clients. Suspicious activity reports, SARS. Financial institutions must report unusual transactions. Financial Action Task Force, FATF, an international body that sets standards for anti-money laundering policies. Asset forfeiture laws. Authorities can seize property linked to illicit funds. Many countries now cooperate closely, sharing intelligence to detect and disrupt cross-border laundering schemes. Famous money laundering cases. Several high-profile cases show how big and complex money laundering operations can be. The Panama Papers, 2016. A massive leak revealed how shell companies were used by politicians, criminals, and celebrities to hide wealth. Danske Bank scandal, 2018. Billions of dollars flowed through the Estonian branch of this bank from suspicious sources, highlighting how vulnerable even major institutions can be. Pablo Escobar's empire. The infamous drug lord laundered billions through Colombian businesses, offshore accounts, and even by burying cash underground. These cases show that laundering is not just a street-level crime. It often involves banks, professionals, and global networks. The human cost of money laundering. While it may seem like a financial crime, money laundering has real-world consequences. It enables drug trafficking, which fuels violence and addiction. It supports terrorism and arms smuggling. It undermines governments by encouraging corruption. It damages legitimate businesses that can't compete with criminal enterprises. Stopping money laundering is about more than stopping financial crimes. Why it's still a challenge. Despite strict laws and advanced technology, money laundering continues because criminals adapt quickly. They exploit new technologies, weak regulations in certain countries, and the complexity of global trade. For every method authorities shut down, new techniques emerge.